Welcome to another month. I'll start again. Welcome to another week of Lunch Money brought to you by Sharesies. At Sharesies, our purpose is to create the most financially empowered generation.
So for those of you who are new to Lunch Money, we do these every Thursday at lunchtime. This is a place where you, as investors, can hear from people leading some of the companies available on the Sharesies platform, as well as other investing experts.
Lunch Money is also available as a podcast on Spotify, Apple Podcasts, and Google Podcasts. If you're listening to us on Apple Podcasts, we'd really appreciate it if you could take a moment to leave a rating and a comment. My name is Leighton. I'm one of the co-founders and co-CEOs at Sharesies.
And I'm Alice. I am a financial analyst at Sharesies. But before we get into today's discussion, we do have a small legal disclaimer. So investing involves risk. You aren't guaranteed to make money, and you might lose the money you started with. Any information we provide is general only and current at the time. And if you are looking for help with your investment choices, we recommend talking to a licensed financial advice provider. Finally, we won't be providing any personalized advice as part of this webinar today.
Just our opinions, and they're not always worth listening to, or certainly if you look at my Sharesies portfolio, but there's a few good ones in there. Also, just a quick reminder that if you have any questions for us, you can submit them through the Ask a Question button down below. Don't leave those questions in the discussion as they are likely to get missed.
And also, please be kind and respectful towards our speakers and your fellow viewers. Otherwise, we will have to take steps to remove you from the webinar, and we really don't want to have to do that.
Definitely not. Today, we are joined by Ross Taylor, CEO at Fletcher Building, Australasia's largest supplier of building materials. Fletcher Building also operates in development and construction and is listed on both the Australian Stock Exchange and the New Zealand Stock Exchange. Welcome, Ross. Thank you so much for joining us.
Kia ora. Pleasure to be here.
Kia ora.
Yeah, great to have you with us today, Ross. Perhaps we just kick things off by you telling us a bit about yourself and your career.
Yeah, sure. Look, I'm probably the biggest disappointment in New Zealand because with a name like Ross Taylor, every time I go around or a taxi driver appears to pick me up, they start with, "Oh, you're not Ross Taylor," and because they're expecting a cricketer. But anyway, so I've it's been an interesting experience. But I've been 3.5 years in the job, almost a bit longer than actually. And before that, I've worked in a number of companies around the world across property, building products and distribution. And that was why I really, when I saw the opportunity to take the Fletcher's job, I was very excited because I figured I had some skills to lend to the company. If I just give you a bit of an introduction then on Fletcher Building, just for those that aren't that familiar with it, our revenues are around $8 billion, about 15,000 people, and about 2/3 of those people are in New Zealand and about 1/3 of them are in Australia. We work across what I loosely call the broader construction value chain. And by that I mean we dig stuff up, quarries and that. We manufacture building products. We distribute them through places like placemakers and TradeLink. We construct and we develop property and residential property particularly. But our focus through all that is really in building products, manufacturing and distribution. So 75% of our profits and revenues are there. And people often think of us as a construction company, but we're much more focused in that building products, manufacturing and distribution. If I look at our competitive positioning, so what do I think gives us a point of difference? We have got scale positions in country in New Zealand and in Australia, and that lets us really take a global perspective. And what we try to be good at is seeing global trends and using our positions to then introduce disruptions or innovations ahead of global competitors. And if we do that well, we usually can perform well in our home markets. And I think that's the advantage of being in Australia and New Zealand, because you're sort of a fair way away. And if you've got a global perspective, you can usually, hopefully, be first to market with some of those innovations. If I had to say what's the investment thesis, given the sort of audience here, and then I'll stop after this, but if I look at it, over the last few years, for those that have followed us, we had a tough period a couple of years ago, and we're through that trauma now, or that reset phase. And if I look at our recent results, our business is performing. We're up to around 8% margins across, or profitability across the business, and that's trending up. So we've put the trauma behind us. We're delivering well as we sit here, but we've laid out a marker that in the next 2 years, we expect to get our profits up to 8%, 10% across the business. So that's an aspiration that we can really see as a visible pathway to, and we've got a strong balance sheet. And I think COVID shutdowns aside, we're in a good market. We've got tailwinds. They look stronger for longer. I hate that term, but it's what I feel we're heading into. So I just think with that and our overall what we're doing innovatively and with our growth pipeline, we're really well positioned as we sit here today to take the business forward and do some pretty special stuff with it. So I'll leave it there and maybe let you take me wherever you wish from here.
Yeah, well, I think you've already given us a bit of conversation ground there. Some really impressive numbers. I mean, the size of those revenues are, they're huge. And you can see when you're talking about a 2% increase in your margin, like you were just talking about there, I mean, on a revenue number that large, those are really big numbers. So, I mean, I guess we're interested in some of the things that might get in the way of that and where you see the risks, who are the competitors, and what do you see could be your challenges towards achieving that?
Yeah, look, it's always hard work, but we've got a really strong pathway to get there. So if I look at firstly the 8% we're making now, and that's well up on what we had been doing historically, we've put a lot of work into rationalize the business. So we've gone from being global back to New Zealand and Australia. We've actually trimmed a lot of bits around the business that we just didn't think we could actually win in. So we're through that phase. And the businesses that were really underperforming, we've put a lot of work into to get them back to what was a more confident and performance position. So then if you look at that, we've got three things we then have to believe of what gets us from 8% to 10%. And one is our Australian business. It has been a perennial underperformer. We've got it up from about 1% margins to 3.7% this financial year. We're saying we'll get that to 5 to 7% in the next couple of years. And we've got very good pathways and visibility of that now. And what gets us to 5% if the market sort of stays the same? If the market's a bit better than we think, then we get operating leverage. That'll start to push us up higher. So we say 1/3 of it gets from there. Another third comes from our construction business. And for anyone following it in New Zealand, it's had a hard time a few years ago. Well, what we've done is we're just about through all those projects that cause us problems, and they finish through this financial year. So when we get to FY23 or about a year and a half out, we'll be working on our new order book, and that's really well positioned. We've got 3 billion of forward order book. We do about 1.5 billion a year. It's at good solid margins, and it should naturally lift our construction business to 3 to 5% margins. And the last third of it just comes from further performance improvement in New Zealand. So we've got a very specific pathway there, which is why we're out there in the market saying that's what we're targeting to get to.
Yeah, great. The competitor scene. So, and I'm also interested, you're just touching on Australia then and why you think, 1% does seem thin. I think you said 2/3 of your business is basically in New Zealand, 1/3 in Australia. Do you see that changing? So I've just asked two questions. We'll do the competitive one first, and then we'll go into the Australian growth opportunities.
Our competitors are always complex because because of the number of business. So if I look at our residential property development business start there in New Zealand, it's really against other housing companies. So and we have a particular way to market there. We do sort of completed houses. So we do what's called spec building. So we sell completed houses. A lot of our competitors tend to sell, you go in and you order a house and they build it for you. So that gives us a good competitive niche there. And we've got the scale and the balance sheet to do that. And it works really well for us. Construction, there's a bunch of people building stuff, so you've just got to be really on song. And the way we compete there now is we're just very focused on getting the right sort of risk profile. So we've been very diligent because we're more worried about sustainable profits than growth in that business. If I look at our building products businesses, it depends which product, and it's usually international competitors. Sometimes it's local competitors. And what we do there is we really deeply understand what our price point is and whether we should be manufacturing or bringing it in. And it's very large array. It's hard to pick down one. In concrete, it tends to be where we're going up against local quarrying companies, or if in cement, it's Wholesome predominantly, and we're the only in-country manufacturer in New Zealand, so that we think that gives us a shorter supply chain, and we've kept our plant really efficient. And in carbon sense, we think we've got a real competitive advantage because we're 20% less carbon in cement than our competitors in country, and we've got plans to drive that down another 30 to 40% by introducing volcanic rock into our cement mixes. So we think we'll be very, very competitive in decarbonising cement, which is a big issue for the world because it's 8% of carbon emissions globally. So what we can do there is really important. And in Australia, it's a similar story. So that's how I look at it. So we have to think about our competition up and down that value chain, and we're very focused on it. And there was a second part to your question, but I can't remember it now.
I think you covered both of them.
Okay, right. Okay.
Good job. Yeah. I'll hand over to you, Alice. Let you ask the questions.
Cool. Thanks, Leighton. So, Ross, we were chatting just before we started the webinar about how Fletcher Building has recently released your 2021 financial results.
Yep.
And you made a profit this year, turning around from a loss last year, even beating your own profit expectations. So I was wondering, what were some of the key decisions that you made last year to withstand the pandemic and kind of help drive this performance this year?
Yeah, so I mentioned, there are a few things we did that were pandemic or COVID related, but most of our success in FY21 or the financial year just passed has been about laying those foundation stones over 3 years. It's very difficult to say you can't wave a magic wand in a business as big as Fletcher Building and get an instant result. So the things that drove our profit performance were all about getting our basic disciplines right. How we get our cost points right. How we had a big safety program. We had some real issues with safety. If I go back, so we had to get that embedded better in the organisation. We got our cost points of all of our products, distribution, DCs. We did a lot of rationalisation of our distribution centres, manufacturing footprint to get that under control. We then looked at just our basic disciplines in the organisation, how we do pricing, how we do logistics, etc. That was a big part of it. And all the trimming I talked about. So as we worked through that, we did a lot of that work over the last 3 years, and then sure, we did a few tweaks around what COVID was doing to us, but that was really at the fringes. It was fundamentally the manifestation of all that work. That's why I'm quite bullish and confident that it's sustainable and we can build from here, because it's not just a flash in the pan activity. So, and that delivered, as I said, it was about 670 million of EBIT, and we got back to dividends, very strong cash flows, 900 million of trading cash flows, and our balance sheet's very strong with very little debt. So, and the other things I point to in our results, just as the safety performance, very important to us, and we've really reduced serious injuries, and we've got our recordable injuries, which is your rate, down under 5, which is better than any of our peers, but still a long way to go. And carbon's big, we've committed to the 30% by 2030 and lined up with the New Zealand government, and our carbon's 5% down on 2018, and we've got specific pathways to get us that 30% down. So that's so that was pleasing to see us starting to get some good traction there as well.
Yeah, cool. And speaking of the pandemic just earlier, one consequence of this is, we're seeing across the world supply chain challenges, and seen a lot in the media around, particularly in New Zealand, with building supplies. How's that impacting on your business?
Yeah, well, we're not immune. In the end of the day, what we see, anything that comes in containers is you've got to be very watchful, because that's become more expensive and more elongated as you get, just shipping's busy and ports are busy. So what we've been doing is having to try and rise inventory levels. So if we think something's going to take longer, we try and have more inventory, but sometimes you do get caught, but we then look for alternate products. We're seeing the need, we have to fly things in. If we've got a particular component that comes in containerized, a classic example is our plasterboard plant. There's fiberglass strands go into plasterboard, but the shipping delays were getting so much we didn't have any, and if we didn't get them, we wouldn't have been able to manufacture plasterboard in New Zealand. So we had to fly a container of that in, which cost us $1 million. So that there's stuff like that quite specifically going on, which is hurting, but we're managing it okay, and I don't think it's going to change in the short term. When we bring in big commodities, quite often we'll bring stuff in and move it around by entire ships. That's not too bad, because if you book a whole ship, you tend to get that in okay. And then we're seeing challenges in just commodity lines like timber, you would have heard about in the news probably. But there's areas where the world's busy, and the feature we're seeing in New Zealand and Australia with busy construction sector is a feature around the world. So that's what's putting pressure everywhere. So you're just seeing certain bits of the value chain just getting busy and underserved, and it sort of rolls through. Today's problem might be solved, but there'll be tomorrow's problem, and I think it's going to be a feature for the next 12 to 18 months.
Great. I'm just really interested in you've spoken a lot about carbon here in the results, and it's really pleasing to hear. Firstly, it's something I know that our shareholder base cares a lot about when we run feedback on what the investors and stuff coming through. But are you hearing that from other directions as well? Like, what's the business focus on that, and where do you feel like that? I don't know if pressure is the right word, but where do you think that influence is coming to for you to be speaking so much about how you're going to improve on that?
Yeah, look, but I'll give you a few perspectives because whatever you believe, I mean, what I find interesting these days, the amount of capital that will not invest in you, so shareholders or share capital, if you aren't driving towards at least 30% by 2030 or have genuine broader sustainability credentials, you're starting to find yourself a little bit orphaned. So I think as a company, if you're not on that path, you're not going to get invested in. If I look at our staff and our customers, increasingly, you just won't attract people if you don't genuinely lean into this. And depending where you are, different governments have different settings, but I'm finding that's getting more and more irrelevant, because if you don't drive there, you'll be out of business. You won't have people, you won't get investment, and you won't have customers. So the government settings in the background, I think they're important, but I think you're kidding yourself if you're not going to drive on decarbonisation and broader sustainability. And if I go back, it's interesting in the investor thing, I've been doing this sort of role a long time, and it really wasn't top of mind even 5, certainly 10 years ago. But our investor meetings now, when we have our big shareholders, they very much dig into this and they look for it being genuine. And the other thing you see, there's various indices around there that are purely based on where you get index funds only invest in you if you have credentials, and that's putting more incentive and pressure to do it as well. So I think that car's left, it's in the race and you're off to the races, and if you're not on that boat, you're going to be in all sorts of trouble. Yeah.
It's really pleasing to hear, I would say, from, particularly from really large companies. So that's great. We always like to do a bit of jargon busting while they're in these, so thought I'd tackle a couple of them with you. The first one's Fletcher Building announced a share buyback of $300 million in June 21. Can you explain what a share buyback is, why you're doing it, and how it affects shareholders?
I'll try and do my best shot at making it simple. When you want to return capital to shareholders, you get there's a myriad of choices, but the two main ones that get used are a bigger dividend, which people probably understand, a payout, or a share buyback. The reason a bigger dividend is problematic is because we had a number of losses a few years ago. We're not paying a lot of cash tax at this point, and we actually get back to that, because when you make losses, you get to use those to offset tax until you get back to profits again. So we sort of get back to cash tax and what is called imputations, which means a tax break on paying dividends in the hands of shareholders at the end of this financial year. So therefore, if we did a bigger dividend, it wouldn't be very tax efficient. So what you then look at is share buybacks, and simply what that means is that you basically buy shares and take them off your register. So the reason that works is if you simplistically think about, say there's 100 shares in the business and you bought back 25 of them and cancel them. Therefore, the 75 shares that are left should be theoretically 25% more valuable. So that means that in the hands of a shareholder that didn't sell, you've actually get a value pop. Now, that's the theory of it. It should work that way. So the idea of a share buyback is you buy back 300 million of shares and you cancel them. And that means that the people that have held the shares should see an improvement in the value of their stock. That's the theory behind it, because you have less shares on issue.
It's great jargon busting, and it's great to consider that tax differences and stuff as well, particularly for everyone listening here as well. One more jargon buster, because you've used it a few times. You've talked about the strength of your balance sheet, and it would be great if you could explain why that's is a great competitive advantage to Fletcher's, and just what a balance sheet is as a starting point. Yeah, so
when people talk to balance sheet, the simple way through it, it's really just how much debt you have. So what happens is that as you think about how you you fund your business, what companies generally will do is use an element of debt. And that's a positive because when you're looking at where you source funds from, you source funds from shareholders. So you get equity and you get debt. And equity is generally dearer than debt. But the problem is that debt, the shareholders take a bigger risk for that return, but debt has to be repaid and can send you insolvent if you can't. So you only want so much debt before it starts to get to the point that the debt's problematic because your interest bill's so high that you're struggling to pay it. So it's like getting your own mortgage. If you get too big a mortgage and you don't have enough income, the interest bill gets too much. So when you run a business, you want to always have what I call optimum debt. And so when we talk about a strong balance sheet, we're below what I'd argue optimum debt levels are. And that's because we're trading very well. We've got very strong cash flows and therefore we have very little debt. And that means that our balance sheet is very strong because we could easily take on more debt. The other thing we look at when we do this is we've kept liquidity, because what that means is while we might have much debt, we've got a lot of capacity to draw down on our debt lines. And that means you have a lot of firepower should you need it. So we have, getting up towards 2 billion of what we call liquidity. So we've got low debt and a lot of opportunity should we need it to draw on it from established lines. So we're very strongly positioned. And with going through COVID, we've actually chosen to keep ourselves conservatively position because there's a lot of we think it's a strong market now, but we just think it's prudent to stay on the conservative side of that while there's so much noise and dynamism in the market. So it's just a setting that the board and myself have actually thought is the prudent one for the organisation for the foreseeable future.
Great breakdown. Thank you, Ross. Now, if we move away from the financial side of things a little bit, I'm quite keen to have a chat about current projects that Fletcher's has. And, you do have a number of high profile ones on the go at the moment. What are some of the key considerations that you look for when choosing what to tender for or, I guess the work that you're trying to win?
Yeah, so just again to context, the construction business is about 20% of our revenues, and the thing that gets really important is construction companies. I've been in and around them for many, many years, big ones, and if you're not careful, they blow up on you every 5 to 7 years. And what happens is it's not a high margin business, so you might make 3 to 5% on the business, but you basically sometimes are taking a risk on delivering the total project. And if anyone's ever done a refurbishment at home or built their house, you know how hard it can be sometimes to do it on budget. So when you get into really big projects worth $1 billion or $500 million, the consequences of getting that wrong are severe. So therefore, the way we choose our projects and our risk profile in there is we look for, if we're going to do a big project, we try and only do big projects now where you only bet your margin. So you can't. So if you're doing a $500 million or $300 million job and it doesn't go well, you don't get paid your 10% gross margin. So that's what you can lose, but you don't lose then the 30% overshoot. So we just won't take those sort of risks because that cost us enormously because Fletcher had a number of those risks which it mismanaged a couple of years ago. So when I look at our forward order book, which is the work we've got committed, the only risk we take is we keep it very low. So if we're doing a risk project, it's small. So even if it gets away from us, it doesn't cause us a big issue. And when we do bigger projects, they have to be in what I call their cost plus, i.e. you do the work and charge a margin, or you're only risking your margin so the impact doesn't overly hurt us. Now, we should be able to run those well, but the reason I put it on that setting is that even if we fumble, it doesn't become organisation defining in terms of issues. But my expectation, as I've said, is we get that business should deliver 3 to 5% profitability as we look forward.
Great, thank you. And one other thing I'm quite interested to hear about is, before we were talking about carbon and how that's becoming a huge consideration as part of Fletcher Building. But like going back to the sort of construction side of things, what sort of environmental considerations do you take into account, like when working on these big projects?
Yeah, look, so we'll ultimately, it's very front and center, and so what you certainly start with, waste. So quite often when you're doing a big project, you're knocking something down, or you're actually creating waste as you go. So we're very focused on that, and we put a figure out that we recycle 46% of our construction waste this year, and we're seeing more and more that circular economy. So as we think about our concrete business and aggregates, we're basically setting them all up. We crush old concrete to use aggregate, so we reuse that. We're in our new plasterboard plant we're building down at Torrico. It will use recycled plasterboard into the new plasterboard. So increasingly, all of our, and when we do our plastic pipe business, we're recycling plastic bottles and we put them into plastic pipes. So we're becoming, because a lot of that plastic was getting sent offshore. So we're now trying to set ourselves up to take that load. And if you look at our cement manufacturing process up in Portland, we're using, 2/3 of New Zealand's waste tyres as fuel in the kiln. So we're getting rid of that big problem and burning them in the kiln. That's double benefit. It removes tyres and it displaces coal. So we're not using coal, and it's much less carbon intensive doing that than coal. So there's that element where there's how we're recycling, and then it's the products we're using. Increasingly, you're looking at that life cycle. So you're choosing products that can be recycled as opposed to products that can't be. And I just think construction materials are just going to get transformed, and that's just accelerating. And I think you'll start displacing materials that are carbon intensive. That's why we're so focused on decarbonising cement and concrete, because otherwise that won't be a product that gets used. So I just think this is going to accelerate, and it's quite exciting because it gives you, it's innovative, it's fun to be in, and it actually gives you opportunities to innovate and disrupt. So so it's a double win if you can get on that journey.
Yeah, that's real. Is there quite a lot of R&D budget and stuff that's put that way? Like, do you actually move parts of your balance sheet off towards focused on that, or how do you sort of approach that?
Yeah, we called it out this time because we're really keen to see our shareholders and investors understand that we are investing in our future. So we identified we're spending about 40 million of our OPEX every year on looking at how we drive growth, and that can be innovation in digital platforms, e-commerce platforms. It's into, we're actually trialing, as I said, pozzolans, which are the volcanic rock, into cement to displace that. We're actually doing, we've got a foot on aquarium. We're actually running those to ground and getting the tests done. We're actually looking at bamboo in our board product to displace pine, because bamboo grows at 3 to 5 year cycles. So therefore, as a carbon sink, it's more effective than a pine tree, which takes 15 to 20 years. And we're looking then at some more exotic things. There's polymers for cement. There's ligates, which can potentially replace sort of some of the resins that go into wood products. So, and what we do is we run these programs now where we've got a group of people centrally. There's 5 people in the team, and we tap into the ecosystem of all the startups around the world, and we sieve through those, and we've looked at, hundreds of them. And it's fascinating. You look at these innovators around the world, and they're doing startup companies, and we're working out which ones are interesting. And there's some amazing stuff. There's a one example of how exciting it could be is there's companies now that have worked out to take carbon emissions off the top of your chimney, say a concrete stack at Golden Bay. You wash it over this bed of chemicals and limestones, and you create aggregate. So it becomes a carbon sink. So you actually then cement or concrete could become carbon negative, and it's almost incomprehensible to think that's possible. And they're trialing those things now. So we're staying very close to those technologies because there's such an opportunity that betters society in the world, but also as a business as well. So it's really interesting stuff, and some of some really wacky people out there, but they're fun to hang around with.
Oh yeah, I love that dream and innovation. That's so cool to hear. I'll just go one more question, just conscious of time here, but I think it's an important one. There was a lot of media around it last year. There was the agreement that was made with the government to sell Ihumātao and the Crown, and that means that the planned development there isn't going ahead. So I'm just interested, firstly, what that means for Fletcher Building, but also the key learnings that you've taken from the experience.
Yeah, I think it needed to happen. I think it was a deal that was necessary, because whatever. If I give you a bit of background, as much as as a big corporate, once that mood turns against you and you find yourself having to explain yourself, it doesn't matter half the time whether your facts are right, because the social media storm it created, we just couldn't get cut through. So as much as we thought we had a reasonable position, no one was really listening. If that's how I'd characterize it. To give you some sense of it, I mean, we take our position very seriously in those developments, and we had engaged with the 13 iwi in Auckland before we started the development. We worked with them. They were quite comfortable with our plan. We'd actually, through that group, actually decided who had mana whenua, land interest and rights, and we were working with those specifically as partners on the development. And we'd actually, through that process, gifted back a third of the land, and actually we're doing some dedicated housing for iwi on the site. So as I look at the whole thing in the round, I mean, I was very comfortable, and we take it very seriously what we're doing. That said, we ended up in the situation we did, and there was no sensible way out of it for us that I could see that wasn't going to be dramatic for everybody, and we were getting, it overshot from my perspective. We were getting protests and death threats and all sorts of stuff on staff, and many of our staff members having to have security around them just because of that. So it sort of got quite toxic, and I think the right answer was the government and the Crown taking it off our hands, and they're going to, we got out of it for cost basically, and I was happy to do that because I saw no way forward on it. So I think it was a very unfortunate place to find ourselves, and that was the best worst solution, for want of a better, the least worst solution to get out of it. In terms of how we think about it, we're very cautious. I mean, we won't go near a site like that again. I think it's too hard. I mean, we that'd be my reflection. I mean, we spend a lot more time looking at just the background on land now and make sure there's nothing that's potentially that complex, because I think as a big corporate, you're sort of almost guilty till proven innocent, unfortunately. So it's easier to say. We have very good relationship with many iwi partners, and a lot of our property development land we do in partnership with iwi. That was an unfortunate one that ended up on the wrong side of it for us.
I'm just aware of time, and we have had a whole bunch of questions come through from people who have been listening in. So we might move to them now. The first question, it kind of goes back to some of the things we have touched on a little bit, but talking about the wood shortage in New Zealand, like how dire is the wood shortage in New Zealand, and is the current building model sustainable for the next 20 years?
Well, there's two questions there. I think the wood shortage ultimately will get sorted. It's just the issue is not raw material, it's actually sawmill capacity, and it was a combination of a number of consolidations going on in one of the main suppliers' mills that didn't go quite well. They were consolidating to one bigger mill, and they're having to sort of regroup and get that capacity sorted, as well as the market got busier than everyone thought. Coming out of COVID a year and a half ago, everyone thought that it'd be a softer market. Everyone got surprised. So that combination caught everyone, or the structural timber mills on the hop. That will progressively get solved over the next couple of years, but it will keep tight for a period. And I don't see any solution to that for the next 12 months. It'll be more of the same. That said, there's other capacity constraints in the sector. What you find is that it's not always timber. I mean, there's supply around insulation got complex because one of the main importers, who are our competitor, is having a problem with their Malaysian plant. So that's sort of causing an issue with home insulation. So you see that cycling through, and I think that'll solve itself slowly, but it will take a little bit of time.
Great. And then this next question, there are a couple of parts to it. The first part is, what is the 5-year outlook for Fletcher Building?
We've promised the market, and including all you, if you're shareholders, that we'll update our 5-year plan later this year. So I owe that to the market, because back in 2018 we laid out a 5-year plan, which was to fix the business and get it up to 10% profitability with a good growth profile. And I've been very wary of walking away from that, albeit that was FY23. We get to the end of that, because I love the discipline of having to deliver what you say you will, as opposed to always moving it off. But as I look forward, what we'll be talking to in June is our next look forward, and you can see the themes of it. So we want to get the profitability. I think 10% is sort of where we should be, at least, but then it's all about now growth. And you see us starting to talk about our growth engines. We talk about apartments in resi, extra housing, offsite manufacturing. We talk about what we're doing with pozzolans and concrete. I think that's exciting. We talk about over in Australia a big kitchen disruption play called Haven Kitchens, which is really about disrupting the flat pack model. So what I'd hope to be talking about is more of those that people can say, oh, I can see where innovation and growth is going in this organisation, and we'll talk more fulsomely about that in May, June, and then lay out the trajectory over the next 5 years.
Great. No doubt there'll be a few people listening in who will keep an eye out for that.
And they'll no doubt keep me honest.
The second part of that question was actually how has SkyCity Convention Centre affected working, and when do you expect this to fully recover?
Look, so the SkyCity, an anecdote first. When it caught fire, I mean, we weren't that far away from finishing it. No, it was in a board meeting, and in Penrose, where offices, and you can't see the skiddy, but you can sort of see Sky Tower over the hills. And I got a call saying, look, the fire started, and my first question is, everyone's safe? We got everyone out, but then you see this black billowing smoke, and you just sort of think, you think, my God, anyway. So we had to, that was quite devastating for the team and everyone. I mean, it's quite dramatic when you've got to start again on something like that. But anyway, you dust yourself off. That's life. So where we are now is it's very complex. We had to get it all. It was a mess in there, and unbundling that mess safely was difficult. It was the danger of falling objects, but it was also what occurred is with all the water that went in there, and it was summertime, everything got mold, and the mold was deemed toxic. So what that meant is you had to go, any way you could work in there was full body plastic, like going into a contagion site, so a full headgear. So that was the work environment for the first 18 months. We're only just come out of that. So now where we are is we're actually well into the final dismantling of the facade, because all that stuff's damaged, and so we have to get it back to what I call undamaged base before we can move forward. So that's what we've been doing. So we're getting close to that, and then we get to go forward again. So it's effectively strip it all down and then rebuild it. It's quite, but the team there's new. They're very excited about it. So we had to resettle that because the poor team that was there before, we've given them different jobs. They were a bit depressed about the thought of restarting it after so many years. But anyway, so look, I'm quite excited about what we'll do. But we're through the grieving. We're now into the excited and committed to get a good convention centre for New Zealand. But it will be, as Sky have announced, 2024. Late 2020.
Yeah, I imagine that must have been quite like a heart-sinking feeling when you saw the smoke coming over the hills.
You couldn't have scripted you think, you're kidding me, really? Anyway, I won't go there. I thought a few other words than that, but that's the user-friendly version.
Great. Now, this next question is from Susan, and she's asking, what is the advantages and disadvantages of listing on both the Australian and New Zealand stock exchanges? And to that end, is there any difference between, the stock listed on the two exchanges?
No, dual listing is purely to make it easy for different shareholders, and we're working in this region, and so what we do is by having two listings is it's easy for Australian investors to invest in us in Australian dollars, and New Zealand investors in New Zealand dollars directly. So that's the logic of it, and there's no real benefits of listing on one or the other, to be honest. They run in tandem, give or take, and then there's never a very big differential at all. So it just should be easier to pick the domicile you're in.
Great. And this one here is more back to the impact of lockdowns, and what impact will level 4 have on Fletcher Building, and should it run for more than 4 weeks?
So I get a lot of these questions from obviously shareholders. We've been doing the post results round, so I'll talk to it that way. But firstly, the couple of bits of context I'll give you is what you're seeing in generally our share price and competitors. People tend to be looking through it right now because I think with vaccination rates getting higher in both New Zealand and Australia, what the view is that whatever happens with the Delta variant and does it get suppressed or not, is that by the time we get to 80% plus vaccination, both countries will broadly be open for business in 2022 calendar year. So what the markets seem to be doing, give or take, is look through that, and and I think they'll get very focused on our second half or first 6 months of of next year's performance to get a sense of how we're going. In terms of then the impact, so starting with Australia, it's quite variable, but we're still making money in Australia with the lockdowns there, but it's just suppressed profitability. In New Zealand, the full level 4 obviously is very damaging. I mean, to give you a sense, our cost is around 100 million a month. That's what it costs us. So if you have no revenue, that's what you're burning every month, 100 million. So 2 weeks of full lockdown, you can diminish it. You do mitigate some of that. And then as it comes back out, it's a bit more blurry now. I don't really know where it's going to land because we've got to just see exactly what trading looks like as we start to partially come out. But that'll start to ease it, obviously. So the sooner we get out, the better. And then what I do think will happen through the year, though, is what we've seen when you do come out of lockdown, then there's usually a bounce because people are doing the work they're doing, but they've got to catch up on the work that's starting. So you generally get a bit of a lift in activity. So how all that plays out through the year is anybody's guess. But so first things first, let's get back to work, and then we can sort of start to assess where it goes. But I'd expect a post-lockdown bounce. So that'll be interesting to see how the whole year then levels out or not.
Great, thank you. Now this one here is more tailored to yourself. So is this where you saw yourself being when you were 21? And what advice would you give to your younger audiences? So maybe any life lessons you've learned along your career journey?
Yeah, I'll try not to make this too long. It's absolutely not what I thought I'd be doing. I mean, a fun fact, when I was in Brisbane, where I grew up, I was working in a construction company called Civil and Civic at the time, and the branch manager, he looked like he had a really good job, and he was running so my aspiration, if I could, was to be the Queensland branch manager of Civil and Civic. But anyway, I remember being in Singapore working overseas at one point and saying, "Oh well, that's probably not going to happen because I can't see myself living in Brisbane again." But anyway, but I mean, the advice I give, and I give it to my kids as well. I think that if you can do something that you enjoy, that you just don't do it for money. You've got to have a bit of passion about it. There's no Pollyanna job that you love all the time, but so try and align whatever you do with your passions, because it's not about being a CEO, that it's about enjoying your life and leaning into it, and think you've got one life and try to do your best to actually make it count and have fun and enjoy it and make it fulfilling. And I mean, it won't be perfect, but that's, I think, a much better place to start. And the other thing I'd also say is be very careful of getting too set in your ways. And I think you got to look out for those shiny things. Every now and then you'll see something, you might say, I'm going here, but you say, my God, that looks interesting. And don't be afraid to grab them every now and then, because they really take you in interesting directions. And if there are things that are interesting and exciting to do, you suddenly find yourself with different experiences and different outlooks that you would never have had if you just wanted to go that linear path. So I think lean into your passions and grab shiny things if you can. So make of that what you will.
Great advice.
Yeah, that's a great note to wrap things up on. So thank you for tuning in, everyone. And massive thank you, Ross, for joining us today. We really appreciate your time and your insights.
Pleasure. Thank you.
Please check out our new daily financial news podcast recap. It's around 10 minutes long and published at 5 p.m. Monday to Friday on Spotify, Apple Podcasts, and Google Podcasts.
And for Lunch Money next week on September the 9th, we'll be joined by Grant Webster, who is the CEO of Tourism Holdings. Now, Tourism Holdings is a major provider of camper vans in New Zealand, Australia, and the US. They also run a number of tourism companies in New Zealand. So we'll hear from Grant and how they've navigated a challenging year and what their plans are for the future. So you can register through the link that should be appearing in the chat right now.
Thanks so much again, Ross. We really appreciate you joining us to share your story with the investors through Sharesies, and many of whom I'm sure will be shareholders in your company as well. To everyone listening, we'll see you next Thursday. Enjoy the rest of your week and stay safe. Haere rā.
See you. Bye-bye.